You turn on a tap and water comes out. It has always been that way, so you assume it always will be. You pay maybe $40 or $50 a month for it. Less than your phone bill, less than a streaming subscription, and you probably haven't thought about where that number comes from since the day you moved in. Here is the part that doesn't add up. The pipe that just filled your glass might be running through a system that costs more to build than a fleet of commercial airliners, financed with debt that takes 40 years to pay off, regulated by an agency that can block a rate increase you desperately need, and staffed by workers who have to test water quality every single day, forever, with zero tolerance for failure. And yet, the company that runs it often makes less profit than the coffee shop on the corner. Owning a water utility might be one of the strangest businesses on earth. It is treated as a public necessity and run, in most cases, as a financial enterprise. Cannot go out of business, cannot really compete for customers, and cannot simply raise prices when costs go up. So how does anyone make this work? And why do so many water systems, even in wealthy countries, quietly fall apart? Let's start with what a water utility actually is. At its core, it is an organization that takes raw water from a river, lake, reservoir, or underground aquifer, treats it until it's safe to drink, and pushes it through a network of pipes to homes, businesses, hospitals, and fire hydrants. Then, on the way out, many of these same utilities collect the used water again, run it through a wastewater treatment plant, and release it back into the environment clean enough not to poison the next town downstream. In the United States, roughly 80% of the population is served by publicly owned water systems, meaning cities, counties, or special water districts run them, not private corporations. The rest is served by investor-owned utilities, companies that operate for profit but are still tightly controlled by state regulators. Globally, the split looks different. Much of Europe leans public. England is a rare case where the entire water and sewerage system was sold off to private companies in 1989, and that decision is still generating headlines today. Altogether, the water and wastewater industry is a genuinely enormous sector, with the American water infrastructure alone estimated by the Environmental Protection Agency to need $625 billion in investment over the next 2 decades just to keep the taps running reliably. Why does this business exist in something close to its current form, rather than as dozens of competing companies fighting for customers the way cell phone carriers do? Because water distribution is what economists call a natural monopoly. It makes no sense to run 3 separate sets of pipes down every street so that competing water companies can duel for your business. The infrastructure cost is so enormous that having one provider per region is actually the efficient outcome. But a monopoly with no oversight is dangerous, especially for something people cannot live without. So almost every water utility in the world operates under heavy government regulation in exchange for that guaranteed customer base. Now imagine you actually wanted to build one of these systems from scratch. What would it take? First, you would need water rights, the legal permission to draw a certain volume of water from a river, lake, or aquifer, which in some regions is itself an incredibly contested and expensive asset. Then you would need a treatment plant, a facility using filtration, sedimentation tanks, and chemical disinfection systems like chlorine or ultraviolet light to strip out bacteria, parasites, and contaminants. A mid-sized treatment plant alone can cost tens of millions of dollars, and a large one serving a major city can run into the hundreds of millions. Then comes the part that swallows most of the money: the distribution network. Miles upon miles of underground pipe, pumping stations to push water uphill and across long distances, storage tanks and water towers to maintain pressure, and valves and meters at every connection point. A single mile of new water main can cost anywhere from $1 to several million depending on the terrain and what's already buried underground. Multiply that by a city with thousands of miles of pipe, and you start to understand why water utilities are considered some of the most capital-intensive businesses that exist, often requiring more invested capital per dollar of revenue than almost any other industry, including electric utilities. On top of the physical infrastructure, you need permits and licenses from environmental and health regulators, ongoing certification for the engineers and operators running the plant, and, if you're a private company, approval from a Public Utilities Commission just to set your prices. This is not a business you can start in a garage. So where does the money actually come from once the system is built? The obvious revenue stream is the water bill itself, which is typically structured in 2 parts. There's a fixed monthly charge just for being connected to the system, covering the fact that pipes and infrastructure have to be maintained whether or not you use a single drop. Then there's a variable charge based on how many gallons or cubic meters you actually consume, often set up in increasing tiers so that heavy users pay progressively more per gallon than a household using the bare minimum. This tiered pricing does double duty. It funds the utility and discourages waste at the same time. But the water bill isn't the whole story. Many utilities also bundle in wastewater or sewer charges, often calculated as a percentage of your water usage on the theory that whatever comes in eventually goes back out through the drain. Stormwater fees, connection and tap fees charged to new developments, and late payment penalties round out the revenue picture. Then there's a quieter, less obvious source of income. Impact fees charged to developers building new subdivisions, which can generate substantial upfront capital without raising a single existing customer's bill. In fast-growing regions, these development fees can be a major funding source, effectively making new growth pay for its own infrastructure rather than spreading that cost across everyone. For investor-owned utilities, there's one more layer that most customers never think about. Regulators typically guarantee these companies a set rate of return on their invested capital, often somewhere in the range of 9 to 11%, in exchange for accepting price controls. This means a private water company's profitability is tied less to how much water it sells and more to how much infrastructure it has built, and how efficiently it operates that infrastructure within the return the regulator allows. Running a water utility, though, is an unusually expensive ongoing operation. Chemicals for treatment, electricity to run pumps that can consume enormous amounts of power moving water uphill and across distances, and skilled labor for licensed operators and engineers make up the daily costs. Then there's the maintenance that never really ends. Pipes corrode, valves fail, and water mains break with striking regularity. Baltimore's water system, serving nearly 2 million people in its metro area, averages around 1,000 pipe and water main breaks every year because of aging infrastructure, and more than half of the city's water budget now goes toward repairs and replacements rather than expansion. That points to the core financial trap of this industry. Much of America's underground water infrastructure was built in the mid-20th century, with some pipes in older cities dating back over 100 years. Underground assets don't announce that they're failing. They just quietly corrode until they burst, and by the time a utility notices the problem, it's often an emergency repair rather than a planned upgrade, which is far more expensive. Nationally, nearly 9 million lead service lines are still connected to American homes, and replacing each one costs on average around $4,700, a bill that adds up into the tens of billions of dollars across the whole country. Add to that the layer of regulatory compliance. Every water utility has to continuously test for contaminants under safe drinking water laws, and if regulators tighten the allowable limit on something like lead or, more recently, PFAS chemicals, the so-called forever chemicals now found in water supplies nationwide, the utility may be forced into a massive unplanned capital project just to stay in compliance. This is why so many utilities technically bring in steady revenue yet still struggle financially. Their costs are dictated by infrastructure age, regulation, and physics, not by market demand, and they usually cannot simply raise prices to cover a sudden expense. Rate increases require regulatory approval, public hearings, and often take months or years to work through the process, all while the pipes keep aging in real time. This mismatch between fixed, regulated revenue and unpredictable, rising costs is exactly what has pushed some of the most prominent water companies in the world into crisis. Consider Thames Water, the largest water and wastewater utility in the United Kingdom, serving around 16 million people in and around London. In 2006, an investment consortium led by the Australian bank Macquarie acquired the company and loaded it with debt while extracting dividends, a financial strategy that critics say prioritized shareholder returns over reinvestment in infrastructure. 2 decades later, Thames Water is carrying roughly £20 billion of debt, has suffered repeated raw sewage spills into British rivers, and has warned that one of its major treatment works in London is in such poor condition that it risks failing outright, potentially cutting off water to 500,000 people. By 2026, the company was surviving on emergency loans from creditors at steep interest rates. A rescue bid from private equity firm KKR had collapsed, and the British government was actively weighing a temporary renationalization to keep the taps running. It is a case study in what happens when a monopoly essential service is financed like a leveraged buyout instead of a piece of critical infrastructure. Then there's the opposite kind of failure. Not corporate overreach, but public underinvestment. In 2014, the city of Flint, Michigan, switched its water source to save money while under emergency financial management, and the new water was not properly treated with corrosion control chemicals. It ate away at aging lead pipes, leaching lead directly into the drinking water of tens of thousands of residents, including children, in one of the most infamous public health failures in modern American history. Flint wasn't undone by a lack of demand or a bad business model. It was undone by chronic underfunding of infrastructure and a decision to cut a treatment cost that seemed small until it wasn't. On the more stable end of the spectrum sits American Water Works, the largest investor-owned water and wastewater utility company in the United States, serving customers across more than a dozen states. It has built a business model around slow, steady infrastructure investment, predictable regulated returns, and consistent rate increases approved incrementally by state commissions. It is not a flashy business. It is closer to a bond than a growth stock, and that, in this industry, is exactly the point. Utilities that succeed long-term tend to look boring: methodical capital planning, disciplined debt management, and a good working relationship with regulators, rather than aggressive expansion or financial engineering. Looking ahead, the water industry is facing pressures that go beyond aging pipes. Climate change is intensifying both ends of the water cycle, causing longer droughts in some regions and more violent flooding in others, both of which strain infrastructure built for a more predictable past. Cities like those across the American Southwest are already investing heavily in desalination and water recycling technology, treating wastewater to drinking water standards rather than simply discharging it, a process sometimes still met with public skepticism even though the science behind it is sound. Technology is also changing how utilities operate day to day. Smart water meters now allow real-time monitoring of usage and can detect leaks within a household or along a pipeline far faster than the old method of waiting for a customer to call about a suspiciously high bill. Sensor networks embedded in pipes can flag pressure changes that signal a break before it becomes a geyser in the middle of a street. Artificial intelligence is increasingly used to predict which sections of pipe are statistically most likely to fail next, letting utilities replace infrastructure proactively instead of reactively, which is both cheaper and safer. None of this eliminates the fundamental cost of physical infrastructure, but it does help utilities spend their limited capital more precisely. The public versus private ownership debate isn't going away either. Advocates for privatization argue that private capital and operational efficiency can modernize systems faster than cash-strapped municipalities. Critics point to cases like Thames Water and argue that an essential monopoly service should never be run primarily to generate investor returns, since the incentive to minimize costs can directly conflict with the incentive to maintain infrastructure. Neither side has a monopoly on success or failure. Some public utilities are meticulously well-run. Some are chronically underfunded. Some private utilities deliver excellent long-term stewardship. Others have been stripped for short-term gain. The ownership model matters less than the discipline, transparency, and regulatory oversight behind it. So what's the honest answer to how this business actually works? A water utility succeeds financially when it does something almost boring on purpose. It reinvests steadily in infrastructure before that infrastructure fails. It maintains a transparent and cooperative relationship with its regulators so rate increases keep pace with real costs. And it resists the temptation, whether from private shareholders or public budget pressure, to treat deferred maintenance as free money. It fails when someone, public or private, decides that the infrastructure can wait one more year, and then another, until decades of delay collapse into a single unaffordable bill, sometimes paid in dollars and sometimes paid in a public health crisis. Water utilities don't fail because people stop needing water. They fail because the true cost of delivering it safely year after year gets quietly deferred until it can't be deferred anymore. The tap will almost always keep running. The real question this industry keeps answering, city by city, is who ends up paying for that and when.